Over the past few weeks, I have been diving deeper and deeper into trying to understand the world of banking and how a bank business works, and whether or not I might be interested in adding some bank stocks to my portfolio. And to kind of help me along with that, I've recently finished up this book, The Bank Investor's Handbook, which is a really good place to get started if you're interested in investing in bank public companies and trying to understand kind of how they work. I made a video here on the channel last week going through some of the basics of how a bank functions, and in this video I want to go through some kind of real life examples of two different bank stocks. I'm going to compare Bank OZK, which is the largest holding in Phil Town's Rule 1 Fund, to a smaller, probably less well known bank called Hingham Institution for Savings. Now, as with any time I cover individual stocks here on the channel, this is not intended to be a recommendation to buy or sell or anything like that. Rather, I'm just trying to work through some examples of some of the key metrics that I am learning about and that I would look at when analysing banks as potential investments. I'm also not going to talk about valuation in this video. I really want to dive deep into understanding some of the key metrics about these two different banks and how they kind of compare to one another. So if you're interested in another video on bank valuations, definitely let me know down in the comment section below. But without further ado, let's get straight into the video. If you do enjoy it, please hit like and also subscribe if you're new here, and I hope you enjoy this one. Now, at its core, banking is really a commodity type industry. As much as every bank will tell you that they have a special way of pleasing customers and that gives them some sort of competitive advantage, dollars that come from Bank A spend exactly the same as dollars that come from Bank B. And there really are a lot of sort of commodity type aspects to the banking business. And for that reason, there are sort of a few different aspects of a bank that we can look at that have some degree of alignment with how you might look at a commodity company. Firstly, we want to understand what their cost structures look like. How much does it cost in terms of fixed costs to run the bank? If you can obviously be a low-cost provider in a commodity type industry, that gives you some advantage. You can still be profitable when commodity prices are low, and similar themes kind of hold true in banking. We also want to look at the sources of money, I guess a little bit like how expensive is it for you to pull a particular commodity out of the ground relative to how much you can sell that commodity for, or in this case, how much interest you can charge on a particular loan at a bank. And I also want to take a little bit of a look at sort of the riskiness of different loans that a bank might be making, and also the amount of leverage that they apply in their operations. So let's start this comparison between Bank OZK and Hingham by looking at the asset side of those two businesses. Now, the vast majority of assets for a bank are going to be loans that they are making to a particular customer. And of course, we want to kind of try and understand the loans that these different banks are making. Now, it's worth noting that banks will have other assets. So in the case of Hingham, they do have about an $80 million or so equity portfolio. So you'd also want to understand what's in there, but that is kind of not the topic of this video. We're going to focus purely on the loans for this one. And there's really two metrics that I want to look at here. The first one is a net interest margin. Now, a net interest margin basically describes the spread between the interest that you're paying people who have deposited money at your bank, call it 1%, and the amount of interest that you are charging out on a loan, call it 4%. So if you have 1% kind of cost to source that money from your depositors, you can lend it out at 4%, then you would have a 3% net interest margin. Now, at Bank OZK, the 10-year average for net interest margin is 4.6% versus 3.2% at Hingham. Now, there is, of course, another important aspect that we want to look at outside of just purely the net interest margin. A bank could have a very high net interest margin if they took in deposits at 1% and then lent them out all on credit cards at like 20% a year or something. But that means that the bank that's obviously lending on the credit cards is likely to have some lower quality loans, and they're more likely to have, some of those loans go south if they're purely focused on credit cards, as an extreme example. So in terms of the business model for Bank OZK versus Hingham, Bank OZK has a slightly more diversified, or significantly more diversified business than Hingham, but a key part of their business is in real estate, and in particular construction loans related to real estate, which are one of the more risky types of loans that you can do in the sort of commercial real estate sector. Obviously, if a development gets completed and then they can't find tenants or something, that's more likely to mean that they can't make their interest payments versus someone who's buying a regular home for themselves to live in, or someone who's buying a commercial property that is already built and could easily be rented out, or maybe even already has tenants. So Bank OZK are doing some of those construction loans, which are probably significantly more risky than many of the loans that a company like Hingham is doing. So Hingham has a very, very simple kind of business model in terms of the loans that they make. They basically do commercial and residential real estate loans, and that is it. They sort of pride themselves on the amount of things they don't do versus the things that they do. So although we see a higher net interest margin at Bank OZK, they probably are taking slightly more risk than someone like Hingham. And where we kind of see that number show up is in a metric called net charge-offs. I'll put up a screenshot here of net charge-offs for Bank OZK, which essentially are a percentage of the loans that have gone south and Bank OZK aren't going to be able to recover any funds from. And you'll see that in recent times that net charge-off figure has been very, very low for Bank OZK. It was only 0.06% recently, but it got right up to 1.75% in the global financial crisis. If we compare that to the net charge-offs at Hingham, the loans that have gone bad at Hingham are kind of laughably small. It actually peaked out at about 7 basis points in the global financial crisis, so about 0.07%. So the best year that Bank OZK has basically ever had with net charge-offs, where they were the lowest, is basically equivalent to the worst year that Hingham has ever had. So although Hingham are getting a smaller net interest margin on their loans, they are taking significantly less risk to get those interest payments. Next up, let's have a look at the kind of source of funds for the loans that Hingham and Bank OZK provide. Now, as a general rule of thumb, the cheapest source of funds possible is basically from deposits, and ideally longer term deposits where people, stick their money in a bank, or they maybe purchase a CD or something like that. Now, that isn't always possible where you can get the entire amount of funding that you need to make your loans purely from deposits, but they are the cheapest source. Now, if we look at the liabilities for Bank OZK, they have about 20.3 billion in deposits versus about 21.87 billion in total liabilities. So of all their liabilities, of the vast majority of their sources of funds to make these loans, north of 90% of it comes from deposits, which is a very good sign. And although it's not huge in the grand scheme, there is one little red flag in terms of sources of funding for Bank OZK, which is that they have about 339 million in preferred stock, where they're paying 4.625% interest on that preferred stock, which is definitely about as expensive as it gets in terms of a source of outside funding. But that 339 million admittedly is small relative to the over 20 billion in total liabilities. Now, if we compare that to Hingham, Hingham were really shining on the loan side of the equation, where they were getting a sufficient return and taking very little risk, as far as we can tell by the numbers on the loan side. On the deposit side, it's a little less impressive. So they have a loan to deposit ratio north of 100%. It's 126% at the moment, which basically means in order to fund the loans that they are providing to people, they need to find an alternative source of funding outside of purely just deposits. Now, in the case of Hingham, a significant portion of that extra funding comes from Federal Home Loan Bank advances. I'll put up the exact numbers on the screen here so you can kind of see the proportions there. And if I go through and look at their latest 10K, it looks like a significant amount of that funding is at less than a 1% interest rate. Looking further through the balance sheet for Hingham, it doesn't look like they have any preferred stock or any other forms of debt. Now, banks do have other expenses than just the amount of interest that they pay depositors, or they pay preferred shareholders or debt holders or anything like that. And that could be really captured in something called an efficiency ratio. An efficiency ratio basically looks at what proportion of their net interest income are they spending in expenses. So things like salaries, things like maintaining branches, spending money on IT systems, all of that is essentially captured in an efficiency ratio. ratio. So ideally we want this efficiency ratio to be as low as possible. You know, they have the lowest possible fixed costs with salaries and all these other things. And if we look at the numbers for Bank OZK and Hingham, in both cases they are quite impressive. They are ahead of the industry, or they have a lower efficiency ratio than the industry. So that's what the numbers look like here for Bank OZK. As of their last 10Q, they came in at 38.2%, and they've got a steady downward trend in efficiency ratio. Now, if we compare that to Hingham is kind of off the charts impressive when it comes to their efficiency ratio. For 2021, that was only 21.31%. And if we look at the long-term trend for that efficiency ratio, it has steadily come down over time. Now, if you were looking at either of these two companies, it would warrant some digging to figure out how exactly they are driving these low efficiency ratio numbers. If they're doing it by severely underpaying staff or being severely understaffed or something like that, that's probably not a particularly sustainable trend as these banks continue to grow. So that's something you may want to dig into, but on the surface of things, both banks look good and Hingham looks spectacular in terms of a low efficiency ratio. Now, the final thing I want to look at here is leverage. One of the things that really scares people off from investing in banks is just the amount of leverage that's inherently in a banking business model. If you have obviously a small negative change in your return on assets, you can have a dramatically negative change in your return on equity if you have a very high degree of leverage. And people sort of generally think that the lower amount of leverage that you have, the safer kind of that investment is, or in this case, the safer the bank is, and that's not necessarily the case. So let's kind of spend some time digging into that. Now, if we look at some of the basic metrics for leverage with Bank OZK and Hingham, Bank OZK has assets to equity of 6.5 and Hingham has assets to equity of 12.4. So Hingham is significantly more leveraged than Bank OZK. So looking at those initial metrics, you may think that Bank OZK is a much safer place perhaps to invest because they use significantly less leverage and kind of more things would have to go wrong for Bank OZK to fail versus at Hingham. Now, all things being equal, that would certainly be the case, but with these two banks, all things are not equal. So we have two quite different types of loan profiles, you have to remember. So it looks from the metrics like Bank OZK are making more risky loans. They earn a higher return on assets and a higher net interest margin, but they have a larger number of charge-offs, whereas Hingham isn't earning as high a return on their assets, but they have a very, very few charge-offs and are making much safer loans. So you could certainly make a valid argument that Bank OZK probably should operate with less leverage, and perhaps Hingham could operate with more leverage in order to juice up their return on equity, because they have, as long as history continues to hold true, they've had a very disciplined degree of underwriting their loans, and they haven't taken a huge amount of risk in that area. So if we do a final summary in terms of looking through some of the key metrics and comparing these two different banks, Bank OZK definitely wins in terms of their net interest margin and their return on assets. However, Hingham, on the other hand, have much lower net charge-offs, and they actually have a higher return on equity than Bank OZK. So even though they have a lower return on assets, since they use significantly more leverage, the equity of the shareholders is generating a greater return. So Bank OZK have a higher return on assets, but that return on assets is volatile as net charge-offs kind of move around with what's happening in the broader economy. And again, Hingham have a lower return on assets, but it has been much more stable than it has been at Bank of the Ozarks. In terms of funding, Bank OZK is doing a great job on the deposit side, but they do have that small amount of preferred stock, whereas Hingham are struggling a little more on the deposit side than Bank OZK, but they do have a relatively cheap additional source of funds through Federal Home Loan Bank advances. And finally, the efficiency ratio, looking at some of those fixed costs, are pretty good on the Bank OZK side, and they are frankly spectacular on the Hingham side. Now, of course, if you were looking to invest in either of these banks, there are other things that you might want to consider. Are their previous results likely to continue forward into the future, or are they having some significant change in business model? What does the valuation look like? And of course, who's running the bank, and do you trust that the management will continue to run the bank in a prudent manner that you would agree with as a shareholder? But I hope that gives you a nice overview of some of the key metrics that you might want to look into when analyzing a bank stock, and that is pretty much all I've got for this video. So if you did enjoy it, please hit like and also subscribe to the channel if you are new here, and I will see you in the next video. Cheers.